Hi guys, welcome to this Moneycontrol live stream. You're watching Morning Trade with me, Nandita Khemka. It's a brand new week, lots of cues to digest. We have the RBI policy this week as well, so it's a crucial week for the markets. Over the next 30 minutes, we'll be talking about all the cues for trade. We'll be talking about all the stocks in news, and of course, we'll also be getting all your stock-related queries answered by our experts on the show. So if you have any queries, send them in to us as usual on our YouTube feed, and we will have them addressed. But before we move any further, let's take a look at the top stories at this hour. Wall Street ended lower on Friday after the US jobs edition came in lower than expected. The Nasdaq and S&P 500 tumbled for 4 straight days, notching worst week since March. Asian markets, meanwhile, are trading mixed ahead of the Chinese inflation data that is due this week, GIFT Nifty hinting at a higher start for the Indian markets. Oil prices rise for the 6th straight week after Saudi Arabia and Russia extend supply cuts through September, adding to global supply concerns. Brent now trading around $86 per barrel. Gold, meanwhile, also rises as the weaker than expected July jobs data weighs on the dollar as well as treasury yields. Among key earnings, Britannia reported a weak set of numbers for the first quarter. Company reported flat volume growth while revenue and profit too missed street expectations. Meanwhile, SBI reported an operationally weak first quarter. In fact, domestic margins saw highest decline in 6 years. Brokerages believe deposit repricing will remain an overhang for margins going forward when it comes to SBI. RIL's annual report highlights the conglomerate's expansion plans. The recently demerged financial services arm is set to list soon. Meanwhile, Chairman Mukesh Ambani says the company is aiming to provide affordable green hydrogen as a viable alternative to traditional fuels. Also on the show, we put the spotlight on stocks like Cipla, which has suffered a US FDA setback, Delhivery, BHEL and Balrampur Chini. Let me first bring on board our technical expert for today. Joining me is Rajesh Palviya of Axis Securities. Good morning, Rajesh. Good to have you on the show. We saw markets stage a fairly good rebound on Friday. And this week, of course, we have the policy as well. And SBI numbers came in operationally weak, and we saw that weighing in on the Nifty bank. But this week, where would you expect the Nifty to hover? Would you say 19,400 would be a good support level for the week?
Morning. Yeah, so looking at the data setup, yes, 19,400, 19,300 are attracting the put writing activity since last couple of trading sessions. So that levels are going to act as a good support area on the any corrective action in the near term basis. Though we are almost trading near to 19,500, where is at 19,500 also there is a significant put writing activity is already there. So if we continues to hold above 19,500 level, and if we trades above those level, then possibly some pullback action we can witness in the today's session also, and in next couple of trading session also we can expect some pullback action. As market has already corrected, it's a bull market. Sentiment is on the bullish side. Fund flows are on the buying side. So mid cap, small cap space is also showing good traction in terms of buying. Delivery volumes have picked up. So these all parameters are clearly indicating that, sentiment is on the bullish side. So we expect, pullback is likely to be there in the market for next couple of trading session, and possibly 19,650, 19,750 are the level where Nifty can again, move further higher. Once we able to cross above 19,750 on a closing basis, then possibly again, we will see a resumption of this uptrend, and Nifty can move further higher towards even 19,900, or we can see a new all-time high also in the continuation of this uptrend. So overall, buy and dip should be your strategy for Nifty, and 19,400 should be your stop loss.
Right, that's the view buy on dip strategy on the Nifty. But before I go across to my colleague Neha, I want to speak to you about SBI. We have a couple of queries coming in on SBI. Rajesh, Atul Nirmalkar wants to know a good support zone for SBI. This morning we have brokerages cutting target price on SBI after the first quarter performance. Where do you see the support emerging next on SBI now?
So in the last trading session, we have seen significant profit booking in SBI due to its quarterly number. And now in this process, stock is now slipped below to its 50-day moving average, and briefly it's broken its 200-day moving average also. So looking at the near-term setup, some more pressure we can see in the prices. 570 is the next important support area for the SBI. If at all stock breaks below 570 level, then possibly furthermore pressure we can see, or some unwinding trade we can see in the prices, and then stock can go down to the level of major support area of 555. That is the major and critical support area for the SBI in this decline. So our advice is, though overall market sentiment is on the bullish side, banking financial have done well in the recent past. Some profit taking is happening. So if stocks comes near to 560, 555 zone is again, buying opportunity to buy and accumulate the SBI on the downside. Keep your stop loss at around 550. So if you get any chance to buy stock near 560, 555, try to buy and accumulate the stock around those levels, as long-term setup for SBI is on the bullish side.
All right, the long-term setup for SBI remains on the bullish side. With that, Rajesh, hold your thought. We'll come back to you and talk about other stocks as well. But let me also get on board Neha Dave, my colleague from Moneycontrol Pro, joining in this morning to put into perspective, how to read the SBI numbers, given the fact that, well, first, good morning, Neha. Good to have you on the show. Given the fact that profits have been fairly strong on the back of a dip in provisions, but let's not forget that slippages on a quarter-on-quarter basis have risen. We've seen margins, in fact, margin compression to the tune of 37 basis points vis-a-vis the market that was working with a figure of somewhere around 5 basis points to 20 basis points. So on the margin front, we have seen a big miss come in when it comes to SBI, which is why people are saying that operating performance has been weak. And management has also said that going forward, margin stabilization would be on the anvil. Brokerages have flagged off deposit repricing as an overhang for margins. How are you reading into the numbers? Do you think operationally a few more quarters will be weak going forward, or do you think the worst is over on the margins?
Thanks, Nandita, for having me on the show. Now, talking about SBI, I would say rather than weak, it is a mixed set of numbers. Though there was a slowdown in the loan growth, margins contracted, and there was rise in operating expenses. But if we see the overall profitability, ROA has moved above 1%. It was in fact 1.22% in the current quarter. Now, one argument could be that the profitability beat was driven by higher treasury gains. But if we look at the overall performance, the loan growth continues to be still strong. And the asset quality, despite slightly higher slippages in the quarter, is also very stable. Now, coming to the main concern area for the street, that is margins. Though margins contracted this quarter, this management guidance is very assuring. Management believes that for the full year, that is for FY24, net interest margins could be maintained at around 3.4% level. Now, if that is the case, we don't see any further or significant dent to profitability in FY24. So that's on the margin side. Now, the most important question for SBI is what would be the key triggers for the stock, or what would be the key triggers and what will drive the performance of the bank in FY24. Now, one of the interesting aspects is that the management has clearly guided that the loan growth will continue to be very healthy for the banking system as a whole. Management says that the credit growth could be around 12 to 14% for FY24. For SBI, he sees that this growth, loan growth, will be driven by the retail, which is doing very well. Express credit, which is the personal loans, is continues to grow at around 20% and more. Also, the management is anticipating some pickup in corporate credit. It has already a corporate credit pipeline of 3.5 lakh crore, of which 1.2 lakh crore is already sanctioned. So clearly, the management is confident that 12 to 14% of kind of a credit growth can be achieved in FY24. Margins would stabilize from here onwards, which means a healthy top line growth for SBI in FY24. Now, talking about the most important aspect, the provision part, the credit cost is likely to remain contained, as we have seen that the asset quality is very stable, and it is the best in the last decade that we have seen. The bank's restructured book continues to decline. It has already provided 30% on this book. The bank also, the early stress account, which is known as SMA, SMA 1 and 2 is also very contained, and the bank has a high provision coverage ratio. So all this means that the credit cost will continue to be low. So we don't see much risk to the earnings for SBI in FY24. Now, and coming to the capital adequacy part, it was very interesting that management highlighted that the current capital is adequate for the future growth. It does not plan to list its asset management business, that is SBI Mutual Fund, or it does not plan to even spin off YONO, which is its a digital app-based platform. So management clearly said that the current capital can support a growth of up to 7 lakh crore of loan book. So it does not see any pressure, or it does not have a plan of capital raising in the near term. What could drive the stock re-rating? See, the earnings could normalize in line with the loan growth in this year, that is FY24. But there is still a lot of scope for valuation re-rating, because if you see in terms of valuation, the stock is currently available at 0.8 times core book value estimated for FY25, which is adjusted for subsidiaries. Now, this is a very attractive valuation, because if you see the return ratios, return on asset has moved above 1% and return on equity is around 20%. So the valuation is very attractive. So long-term investors should actually take this as an opportunity, the mixed set of results, and should be as an opportunity to accumulate the stock at current levels.
Neha, I think you've spoken at length about SBI. My next question was to you about the valuation re-rating, which you've covered. But we've also had Bank of Baroda reporting numbers, and numbers have been a miss. On all parameters when you look at the expectations. Deposit and advances growth, however, have been pretty healthy, and asset quality has also improved. So where do you see Bank of Baroda now? Case for valuation re-rating here, or do you think it's time to look at bigger and other banks like SBI?
So so the preference would be SBI because of its size and the market share gains. As far as other public sector banks are concerned, obviously the operating performance in some cases has been very good. But if we look at the bigger picture or the larger picture, public sector banks, excluding SBI, have been losing market share in terms of both deposits and advances to private sector peers. So in that case, long-term investors, should prefer sticking to the larger names, either large private banks or SBI. There could be some tactical opportunity to play the public sector banks in the short term. However, investor needs to be very, very selective.
All right, that's the view. Then with that, Neha, we are running out of time. Thanks a lot for taking out time and joining in and sharing your thoughts on SBI and BOB at this juncture. With that, let's go back to Rajesh and talk about certain queries that we are getting from the banking pack itself. We have a query coming in on Axis Bank, and we have a query coming in on IDFC First Bank. This IDFC First Bank query is coming in from Vishal Thakkar. As Neha was pointing out that it's time to stick to SBI or private sector banks, would you say Axis and IDFC First Bank are worth looking at the juncture?
So I'll take IDFC First Bank, as I cannot comment on the Axis Bank due to compliance reasons. So IDFC First Bank, yes, stock is consolidating at higher levels since last couple of trading session. Overall structure is on the bullish side. Stock is very well placed above all its long-term, short-term moving averages, which are already adding up the bullishness in the stock. And looking at the overall setup for IDFC First Bank, yes, we do expect that, yes, furthermore upside momentum we can expect in the near term towards 94 to 96. So if you are holding your position, now trail your stop loss around 84 level, and we are projecting target of 96 in the near term basis. Overall long-term setup for the stock is also on the bullish side. So if you want to hold it for long-term also, you can hold it. And we do expect the stock may perform further higher in the long-term basis also, and possibly 100 plus level we can expect in the medium-term to long-term basis for the stock. So hold your position for long-term also.
All right, that's the view on IDFC First. Hope that answers your query. But let me also talk about, the stock of the day, Delhivery. The stock had already run up a fair bit ahead of numbers on Friday, and it reported its numbers post-market hours it has narrowed its Q1 loss to 89 crore rupees sharply from 399 crore rupees in the same quarter last year, and operating losses have also reduced sharply, and revenues have grown in excess of 10%. Rajesh, in Friday's session, we saw Delhivery rally somewhere around 5% or thereabouts. It's still quite a distance away from its 52-week highs. But would you say the stock is poised to hit that 500 mark anytime soon, or would you say that some bit of profit booking could kicking in today's session, given the fact that the stock has already run up quite a bit?
So we have seen stock has shown positive tick ahead of number, and stock is very well placed above to all its important moving averages on the near-term, short-term basis. Looking at the daily, weekly time frame, stock is almost trading near to its multiple supply zone. So if at all the stock crosses above 425 to 430 zone, then possibly stock may witness further more buying action, as because this is the breakout level on the weekly chart, and stock is forming rounding bottom sort of formation on the weekly chart. So once stock crosses above 430 level with volume action, then yes, stock can move further higher towards 470, even 500 zone also. So stock is in process of forming a bottom after a corrective move, and now 430 is the important level to watch for in the today's session. Any breakouts above 430, it's a buy for upside target of 470 to 500.
All right, those are the targets to watch out for on Delhivery. Let me talk about the Pharma pack now. There is some bit of negative news coming in on Cipla. Of course, we've seen quite a good rally come in on shares of Cipla, given the fact that there are reports that Blackstone may be interested in buying out the promoter's stake in the company, and of course it also reported great set of numbers for the first quarter. This morning we have a US FDA classifying its Pithampur unit as official action indicated. Now this means that the company has failed to meet regulatory requirements, and it could be subject to further regulations or regulatory action pretty soon. But the company has said that there is no material risk to commercial product portfolio, or and the company is rather in fact committed to address issues relating to this plant within the stipulated time. But of course we saw a great rally coming in on shares of Cipla. I think on Friday itself it had hit a fresh 52-week highs, and we have a query coming in from Saurabh on Cipla as well as Lupin. In fact, given the fact that Pharma index has hit a fresh high, he wants to know if it's the right time to enter into some of these names like Cipla and Lupin. Would you expect some bit of selling to kick in when it comes to Cipla after the kind of up move that we've seen? And what are the targets one should be watching out for on these two counters, Cipla and Lupin?
So overall, if we analyze most of the pharma stocks have done well in last couple of weeks, and most of the stocks are now trading above to their short-term breakout levels, above short-term breakouts level. Most of the stocks are holding their long-term moving averages. If we analyze the Cipla setup, in the previous week, stock managed to give breakout of its previous swing high of November 2022. Though there is a news flow, so if at all stock slips below 1185, then only we can see some more profit taking or some liquidation in the stock prices. Till the stock is holding above 1185, our view is on the bullish side. And possibly once the stock crosses about 1230, 1240 zone, it may resume its uptrend also, and then we can see furthermore higher level in the Cipla prices. So in today's session, 1185 needs to watch. If it slips below 1185, then you can book some profits, and possibly stock can correct further towards 1155, 1140 zone also. Though stocks have run up quite well in last couple of weeks. So still, if it's corrects towards 1140, 1150 zone is again buying opportunity, as most of the pharma stocks are showing good buying interest. If we talk about Lupin, stock is clearly in uptrend. It's almost sixth consecutive month where we are seeing that higher high low formation for the Lupin, which clearly indicates that there is a sustained buying action is happening in the stock. And looking at the near term, short term setup, stock is in bullish territory. So if you are holding Lupin, your stop loss now should be at around 1025, and we are projecting target of 1095 to 1120 in the continuation of this uptrend for Lupin.
Right, that's the view on Lupin and Cipla, and of course there is plenty buying action or buying interest in the pharma index as well at this juncture. Let me take up a query on BHEL then. The company reported its numbers. In fact, numbers aren't really anything to write home about, given the fact that it has widened its loss in the quarter gone by. But if you look at the order book, it has bagged somewhere around 15,600 crore rupees worth of orders in the first quarter. The stock has come under a fair bit of pressure over the last 7 to 8 trading sessions. And we have a query coming in from Yogesh Tiwari, who wants to know your thoughts on this stock. Headed lower after a weak set of numbers?
So stock was traveling in upsloping channel on the daily chart. In the last trading session, there was a breakdown of this channel. So looking at the near-term, short-term setup, yes, if stocks continues to trade below 102 level, then yes, possibly further more liquidation we can see in the stock, and stock may correct further towards 95, even 94 zone, which is the next important support area for the stock. Though stock is holding about to all its short-term, medium-term moving average, so overall structure is on the bullish side. But yes, for the near-term setup, some profit taking or some pressure we can see in the stock prices towards 94, 95. Again, if it comes around those level, you can buy in the decline. Keep your stop loss of 90 rupees to hold this stock if you are buying this stock on the decline.
All right, that's the view on BHEL. Then let me quickly take up a few more queries that are trickling in this morning. Charan Shetty wants to know your thoughts on Ceat. This stock has been stuck in a range, in fact, hasn't done much over the last 1 month or so. Sorry, what would you advise investors to do on this one?
So most of the tire stocks, auto ancillary stocks are showing good traction. And if you talk about Ceat, yes, it's almost trading in a very tight range since last couple of weeks. So the range for the stock is 23.60 on the downside, and on the high side 25.40. So once the stock crosses about 25.40 level, it will resume its uptrend. Though overall setup for the Ceat is on the bullish side, as the stock is trading about all its important moving averages. Overall structure on the long-term basis is also on the bullish side. So most of the indicators are indicating that yes, sooner or later we will have a breakout about 25.40, and then stock can move further higher towards 26.50. So you can hold your position if you have bought for short to medium term investment perspective. Keep your stop loss at around 23.70, and on the higher side, once crosses about 25.50, your the next target for stock is around 26.50 to 2700 on the higher side.
All right, those are the levels to watch out for on Ceat. Last query for today. This one is coming in from Vishwas Jain. Wants to know your thoughts on Punawala Fincorp for the next 10 years. Now, stock has done fairly well in the last week or so, up 10% or thereabouts. For 10 years, should one hold on to it?
So 10 years is very long-term time frame, and it's very difficult to comment on for the 10-year perspective based on the technical setup. Yes, if we analyze the last 2-3 year historical performance, the stock is doing good performance in terms of financials. Quarterly numbers are also encouraging. But yes, I can give a view based on the technical setup. So my view is on the bullish side. Yes, buy on dip should be your strategy. Looking at the long-term setup on the technical front for next 1 year to 2 year perspective, yes, stock can move further higher. And we are projecting target of 550, 600 on the higher side for next 1 to 2 year time frame. You can buy and accumulate the stock if you get any chance in the volatility. The major support area on the downside is around 340, 350 zone. So that should be your stop loss to buy and accumulate the stock. 600 is the target where we are expecting in next 1 or 2 years for Punawala Fincorp.
All right, that's the view on Punawala Fincorp. Not a very long-term view, but hope that answers your query. Rajesh, this wraps up our query segment for today. Thanks a lot for answering all the viewer queries. But leave us with some stock recommendations for this morning.
So we expect some momentum can be there in cement stocks, and we are bullish on India Cement. And looking at the overall setup, one can buy India Cement for upside target of 235, 240. Keep your stop loss at around 215. Another stock that we like at current juncture, that is India Mart. India Mart has shown a good buying interest in the last trading session. And looking at the near-term setup, we expect that stock can move further higher towards 3200, 3250 in the continuation of this pullback action. and even your stop loss should be around 3070. And the third stock that we like at current juncture, that is from IT space, that is Tech Mahindra. Stock has shown good buying interest in last couple of trading sessions. And looking at the near-term, short-term setup, we expect Tech Mahindra can scale up further higher towards 1220, 1230 zone. So Tech Mahindra is buy with stop loss of 1150.
All right, India Cements, India Mart and Tech Mahindra, 3 stock recommendations coming in from Rajesh this morning. With that, Rajesh, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. It's always a pleasure speaking to you. Well, with that, we've come to the end of this edition of Morning Trade. So from me and the entire team that put the show together, thanks a lot for watching. But of course, don't go anywhere because coming up next is Opening Bell.